And the reason for that is they're very powerful, but they're also more easily understood so that you can understand how the machine makes decisions. And we'll go into that a little bit more. And so what machine learning is not. So one of the ways that we like to approach helping people understand what machine learning is to look at the myths of machine learning. And people come to these trainings with some notions about what they've heard about machine learning. And so what we'll do is we'll learn about machine learning by learning through the myths. So myth one is that machine learning is a black box. So as I mentioned, that you can take a few variables and make a bunch of combinations of them and use those as features to get the machine to create a decision. And because of that complexity, it can be difficult to understand how the model actually works. The reason you need to know how the model works is for your risk team and for the regulators who require banks to have model governance and be able to describe how the model works. And then also from a portfolio governance perspective, you want to know what's going to happen. And so there is transparency technology that helps you understand how the model works. And that transparency technology can be used at the model level while you're designing the model to predict how it should work. It will explain how it works. So if you look at this is output for a MSME borrower. And so this is their different scores. So they have scores to a borrower score and then a decision, a yes or no decision. And then this is where the transparency comes in, and this explains really what effect on the score, and then what had a negative effect on the score. And this can be produced for every loan decision, and it can be used to help better understand the customer, to send them messages about why they were approved or why they were denied, or how they might improve their financial profile so that they can borrow more later. Or you might, as part of the decision-making process, we might look at 12 months of savings behavior, and you might tell them, well, if you saved more money, like if you saved 10% more per month, you'd be able to borrow more later, for instance. And so this is a very powerful tool for understanding the customer. This may look familiar. So when you're looking at what kind of information can be produced about machine learning, you can then use this to predict how the model will make decisions, and then measure that later as the portfolio is operating and you're lending and people are repaying. You can actually run analytics to compare the performance of the model relative to your expectations. And this is an example of how the transparency works. One of the mechanisms is called feature effects. So what we're trying to do is look at every variable or every feature and its individual power to predict the probability of a customer defaulting. So this one has to do with how long have they been a customer of the bank? And so you can see, for years 1, 2, 3, 4, and 5, how long they've been a customer of the bank really does not have much predictive power. But as soon as they reach year 6, then all of a sudden, year 6, year 7, and year 8, it makes a lot of difference on, this variable is more important in predicting the probability of default. And this is from an actual customer here and an actual model. Myth 2, machine learning replaces existing governance and policies which ensure fair outcomes. And so this is really important because machine learning has the ability to learn. There is people sometimes think that it's just going to go learn on its own and go out of control. So machine learning really is in this part right here that's called the scoring model. But you can also layer on top of that a set of business rules and policies. And so all of these together create the lending model. This creates the scores and the sub scores and the customer profile. This defines what a loan looks like, how, what's the min and max amount, how are you going to do fraud prevention? What are your min and max interest rates? What do you want your approval rates to be? Is there going to be risk-based pricing? Are there any constraints around regulatory compliance? And then any policies where you want to force a particular outcome, where you might have farmers who borrowed last year, but there was a drought or there was a storm that wiped out maize farmers in a certain region. And you might want to say, well, this year for any maize farmers in a certain region, even if they were late on their payments, go ahead and approve them for a higher amount because they had some difficulty. So this allows you to help um, help drive your mission, even if the credit score is not as high as it would be. You can also track the outcomes. So these are fair lending type outcomes where we're looking at distribution of loans by age, distribution of loans by sex or gender, distribution of loans by religion or by social structure. So, for whatever your fair lending laws are in Nigeria, these kinds of graphs can be put together so that you in real time are actually monitoring how the lending system is working and that you're not inadvertently biased toward a particular group. Or if you have a mission to lend to 60 or 75% women, you can monitor that here. Even through a fully automated system, you'd be able to just make sure that you're meeting your internal goals. And then another way you can measure performance too is, again, with analytics that are looking at the portfolio in real time, where you're looking at just some of the standard analytics that you would look at: loan portfolio growth, in number of customers, as well as the size of the portfolio, your PAR, bucketed 1 to 30, 31 to 60, 60 to 90, et cetera, that you're familiar with. And then your bad rates. And so this graph in particular synchronizes your days past due 1, 15, and 30 buckets to the distribution week so that you can easily see what the performance of the loan portfolio is relative to repayment rates and how it is improving over time. Myth 3. So this myth 3 and myth 2 are somewhat related when it comes to the machine learning on its own and cannot be controlled. So there are two types of learning. There's online learning, and this is where the machine is just left to train itself. Data comes in and it analyzes the data, and then it changes how it makes decisions automatically. A problem with this is that the machine will be changing and its output will differ from the original model that you built your risk program around. Because loan decisions require consistency and predictability, understanding and control, and there are regulatory requirements, it's better, in our view, to do what's called periodic retraining. So you continuously monitor the model. When you go to update the model, allowing it to learn, you do it on a schedule. You say maybe every 3 months I'm going to update the model, or every 5,000 loans I'm going to update the model. But the idea there is to do the analysis and see if you can, through the model update, improve your portfolio performance. So the idea is to continually have the model continually progress toward business goals. And then here's an example then of that model governance, where this bar across the top shows the different machine learning model versions. And so model 1 ran for 3 months and then was updated to 1.2. It ran for 6 months and was updated to 1.3. And then it ran for another 6 months and was updated to 2.0. And that's layered on top of all of the portfolio performance graphs, so that at a glance you can see changes in the portfolio size as well as your DPD rates. And then myth 4, machine learning replaces business understanding and domain expertise. This is huge because, you know, there is no replacement for the expertise that you have in your institution now. You've been lending to this group of customers. You know how they operate. And so it is more than just this data science problem. Machine learning is used to improve what you're doing, but there's still, you have to understand your business goals, and those business goals are part of the lending program. Note your available capital, your risk tolerance, your product and client segments, regulatory constraints, all of those come together to create the overall platform. So machine learning really can be looked at as process improvement and a key component of digital transformation, but it's not about replacing people, and it's not about replacing expertise. It's about just improving overall lending operations. So, you know, and here's another real good example. So, as part of the digital transformation and building a digital lending program, one of the outputs of that is a very detailed data and process flow. And so just understanding, what is your customer experience? How do they interact with the bank? How do they apply? Where does the data go? Which systems within your institution accept, modify data? So using a process flow diagram making about which machine learning model is the most appropriate for your business to achieve your business goals. So let me stop there, because I'm going to move more into data strategy. But if I'd like to answer some questions, if there are any questions about machine learning and about just the last few slides that I talked about.
Okay. Is there any question is there anything we don't understand we would like just to know about before we move on? You can unmute yourself briefly if you have any. If not, we can move on.
Hello, can you please shed more light with respect to ML replacing, that's myth 4, under myth 4. Can you hear me?
Yeah, I can hear you, but I don't quite understand the question.
No, I want you to go back to the slide of myth 4. I want you to please shed more light. Yeah, myth 4. Shed more light with respect to that in terms of business process improvement.
Yeah, so machine learning is all about the data, and but digital transformation and a successful lending program needs more than just a machine learning system by itself. And so when you're building a full lending system that uses machine learning, you want to make sure that the model is appropriate for your business. And some of those things that are part of the expertise and the historical information that you have in your institution have to do with the business goals. And the business goals can be, you know, what is the say you're starting a new loan product. What is the purpose of the loan product? What type of loan product is it? Is it going to be a consumer loan? Is it going to be a two-wheeler loan? Is it going to be an SME loan? For that, and who's going to be the target demographic? Is it going to be small street merchants, or is it going to be larger businesses that employ a lot of people? And then what kind of capital am I going to invest in that? And what's my capital going to cost me? And what am I willing to risk to grow my portfolio? And kind of what are my expectations for the performance of the portfolio in the first 6 months, in the first year, and then where do I want to be with that portfolio in 5 years? And all of that comes into play when you're evaluating the model. So the model is, so this is assuming that you have some historical data. In the case where you don't have a lot of historical data, you can build a non-machine learning model, a statistical model, and start to run it. And then as you get outcomes for that loan product, then build a machine learning model after that.
Okay. Thank you so much.
Is to monitor it very closely and then make changes as needed.
All right.
Okay.
Thank you.
Thank you so much.
Do we have anything that needs to be cleared up from that part before he moves on? Okay. Sammy Prince, you can speak.
Yes. All right. Thank you very much. My own aspect, I actually wanted him to respond along the line so that you can capture the whole thing very well. My own question centers around looking at our environment here in Nigeria and how we have challenge with data collation, big data, and all sorts of. Now, taking a look at this, how do we factor in these machine learning programs into microfinance institution work ethics and operation, microfinance banks, as well as the upcoming finance houses? How versatile do you think this will work in our environment here?
Okay, that's a good question. One is fully digital lending and machine learning is becoming more prevalent across emerging markets in MFIs as part of digital transformation. So with respect to Nigeria, that's actually what I was getting ready to talk about when it comes to the data strategy. And so right now, the amount of data that is available, let me go to this one. The amount of data that is available, easily available, is not that great. But nearly everybody leaves behind some kind of digital footprints. And a lot of this data is useful for understanding customer behavior. So, and as you know, there have been a number of lending programs that are based on telco data. So it could be a partnership with an MFI, an MTN, or Airtel, or one of those. And we've been involved in those. So the digital footprints left behind through that telco relationship can be used to provision the first loan. So in Nigeria, we're starting to see what are called data partners and data aggregators and open APIs that are making the data more readily available deeper into the market, particularly for customers of MFIs. So there is a company called Okra, which you may be familiar with. They're a CBN approved data aggregator. And what they do is they provide access to customers' bank accounts. It's called customer permissioned, where through say you have a mobile application for applying for a loan, they can actually give permission to get access to their bank account and get a year's worth of transaction data, and then use that to create a loan decision. A lot of this is being made possible through the banking verification number. And I just saw that 44 million of these have already been approved or issued in Nigeria as of October 18th. But that allows this information to be shared actually from one bank to another bank as well. So you could apply for a loan from one bank and then get data from another bank, as an example. So all that to say is today, data is fairly thin, particularly in the microfinance space, but it's growing and it's growing fast. And so the idea around implementing your digital lending platform is that maybe today you don't start with machine learning, but you start with a statistical model or a business rules-based model that you're already working with, and then maybe make some incremental improvements to it, and then start lending on the platform and monitoring it. And then as customers borrow and repay, then you can use that actual outcome behavior to train a model and then begin to introduce machine learning, the machine learning part of it over time. The idea of the data strategy is, what do you want to get from your customers, and what do you want to provide for your customers? And what, in an ideal situation, what kind of data would you like to have on them 5 years from now? And so building the data strategy around, what data do I have today? How can I lend today with the data that I have? And then where do I want to be 5 years from now? And how am I going to get there with my data? And Nigeria in particular, because of the push by this central bank for financial inclusion and the implementation of the BVN, and the data aggregators and the open APIs. This is all, going to become very possible in the next few years. Did that answer your question?
Thank you, Mr. Steve. The other aspect I wanted to talk about, I think you tried to capture it in your closing remark, is the issue of the financial inclusion. You know, most MFI customers, most of them currently at the bottom of the pyramid are not ready to be financially included in the plan. Most of them give excuses of the houses in the banking and all sorts of. But being at the bottom of the pyramid, the MFIs are closer to them.
Right.
So are you saying that for the MFIs, aside from those regulated agents that you have said data can be getting from them, does it mean in line with the operation of the MFI, as part of their own strategy, they can get data directly from the customer, despite the fact that they are not financially included in the financial inclusion program of the country?
In some cases. So the point is, I think that more and more data is becoming available and becoming available every day. So in Madagascar, I'll give an example. In Madagascar, that is of an MFI, and they work like you with the very, very bottom of the pyramid. And they have 3 loan products. They've got a nano loan, all digital loan product, and a micro loan product for SMEs. And so for them, the only data that's available is telco data. And so using that telco data, we were able to build what we call a loan cycle 0 model, or a new borrower model, to be able to lend something to them. And then with better than 50% chance that they're going to pay back. Once they have taken one loan and repaid it, then you have some behavior data there, which is good. And then, there's automatic savings account opening, automatic transaction account opening that all happens sort of in that process. In another example then, and so these are customers that, generally make less than, $10 a day or even $5 a day. So they're very, very bottom of the pyramid, and it's all done with USSD. But again, it's they've left some digital footprints because of that telco relationship. Another segment that's served a lot by MFIs are the micro businesses. And micro businesses, particularly now because of COVID, are, being somewhat incentivized to be able to take digital payments. And so I think you're going to see that grow over time as well. And again, it's kind of looking at, a 3 or 5 year strategy. How can we help our customers today who are cash-based, maybe have a phone, probably not a smartphone, but they might. And then what other data is there that we can get from them or about them to help serve them better? And I just, in my research about Nigeria in particular, the CBN is making a lot of efforts in that area. And I was on what was it? I did another one of these webinars about a month ago, and they were talking, there's another company based in Nigeria that digitizes SME point of sale information. And then that point of sale information, they use it for automatic inventory restocking and purchasing and linking them with their suppliers. But that same data can be used for lending. So all that to say, there's more data coming. And even for the people at the bottom of the pyramid, particularly the micro business people.
Thank you. Thank you very much. Thank you.
That was quite an eye-opener there. Do we have any more questions? Okay, I think you can proceed, Steve.
Okay, so let's see. I talked about so when we're talking about the data strategy, it's about growing the lifetime value of the customer, primarily by serving them better. So you serve them better, they stay with you, and they grow. Sometimes MFIs may have a graduation program where you're trying to graduate them to kind of a regular bank, but others may want to keep them for a long time. In one, not in Nigeria, but in another country, we're doing group loan graduation where we're taking members of groups and using the information that we know about them as part of their group financial behavior to create individual loans for them for affordable housing and individual micro business loans, for instance. So it's another source of data. But the idea is to make that customer profile as wide as you can over time, and then be able to use that data to better understand the customer. The data partnerships, if you, there are a couple of publications I subscribe to that I can send that later, and you may know about them too, but it's based around banking and financial inclusion in Nigeria and just tech in Nigeria in general. But these data partnerships and being able to get more and more data, data from utilities, especially data from the telcos, and then data from apps that are money apps, but are not necessarily related to the telcos. Remittances too. Remittances are a huge source of income for many in Nigeria. And those remittances are very important for understanding the cash flow of a customer and then being able to loan them money. Let's see, digital footprints. We talked about that. Yeah, and so, not easily accessible today, particularly for the segment served by MFIs, but again, you can plan for it. And so when you have, when you're building out your data model and your data process, you just want to build in space for that new data that you think you can collect. And then as it becomes available, collect it. Now, some of that data that comes from these open APIs and these data partners, there is a cost to it. And so for every time you go get a year's worth of bank account transaction data from another bank, it might cost you something. So you just need to evaluate, is the predictive power of that data worth the cost that you have to put into that loan application? And those are things that the machine learning platform can also help you with. And even statistical analysis. If you may actually have data partners where they're really predictive in the north, but not in the south, for instance. So those are things that you can evaluate. So you'd use one data partner in the north and then a different data partner in the south. These open banking APIs, there are fintechs popping up all the time to support these open APIs. Even MTN now has 2 sets of APIs for getting customer permissioned access and access for fintech apps to customer telco data. And so there's the MTN telco APIs, and there's also the MTN Momo APIs. So I have, let's see, we're at 8:44, so I think I had 45 minutes, right? And then some questions. A little bit more detail about the machine learning platform, but I want to make sure I answer any questions that are specific to the implementation of machine learning and data strategy to MFIs.
Hello, Steve. Hello, Steve.
Yes.
Can you hear me, Steve? Okay. I have a question from Christian Isele. I'm going to be reading this question out. He would have chatted, he would have spoken, but I said his background is a little bit noisy.
Okay.
Okay. Okay. I'm trying to read this question out. It says, that's your last chat on Meet 1. It's talking about Meet 1. An actual customer data was predicted using a chart of probability of default, and after year 6, we notice a downward slope of the graph. Is this behavior universal for customer of bank whom we expect loyalty from to dwindle downward? Because currently I notice in my MLB, customers of such duration pattern in same behavior. Do I read the question again?
No, I understand the question exactly.
Okay.
And so I don't think that it's necessarily universal, but one thing we found is that bank account seniority and telco seniority both follow a similar pattern. But across our different types of customers, it's not necessarily universal. And so, one thing that's ideal is to be able to evaluate this variable against your historical data for your machine learning model to see if it's predictive. And that would be part of the onboarding of building out the machine learning model from your historical data. But without analyzing it, I wouldn't just assume, well, if they got 5 years, they're a better risk. They probably are, but it's good to analyze it and see.
Okay.
And just one more point on that. This is describing a transparency technique called feature effects. And so what we do is we may create 100 features out of 25 variables that's used to evaluate the customer. When we're doing the transparency, we isolate each individual variable, and then we run through the range of a minimum and a maximum and everything in between to see how the prediction changes as these variables change. So we'll keep everything else the same, and we'll just have account seniority year 1, and then score the create a score and see what the score is. Then we'll change it to 2 and see what the score is. Then we'll change it to 3 and see what the score is. And what we notice is that the overall score, or the probability of default, really did not change significantly until we got to year 6. And we do that for every feature we create, and do it with lots of computing horsepower to do it for every feature, and then generate those transparency. That's part of generating the transparency information.
Okay. He said it's clear. That is okay. It's okay. It's clear.
That answer your question?
Yeah, I said that he has responded. He said it's okay. The question is clear.
Okay.
The answer is clear. Thank you very much. Come over ahead.
Okay, great. Questions?
Do we have any other questions? Once you are being muted.
Not a question, but hello?
Okay, I can hear you, Sammy Prince. Continue.
Okay, thank you.
You're welcome.
What I want to ask is not a kind of question, but a kind of feedback to know. This program of this machine learning operation, as it entails, is capital intensive, or is it something that can be recommended for my organization, considering it's a sector that is coming from as an MFI?
So it is not that capital intensive. It's every company that does this takes a different approach, and I'm not here to sell. I'm here to sell you on what we do. I'm just here to kind of inform, but the approach that we take is pay as you go. And so there's a small upfront fee to do the model development and the integration with you, and that data strategy. And then after that, it's, depending on the type of loan, the size of the loan, and the volume, it's, so much per loan. If we're doing 10,000 loans decisions a day, like we do in Madagascar, it's a very small amount per loan decision. If we're doing an SME loan that is the equivalent of $10,000, but they're only going to do 5,000 of those per year, or 2,000 of those per year, then the amount per loan would be somewhat higher to cover the costs. But it's all cloud-based, so you don't have to have computing infrastructure, and you don't have to have high-powered analytics machines to be able to do the calculations. It does take some volume. Generally, it takes some volume to be applicable. I mean, if you do 200 loans a month, it's fairly easy to do that with a couple of loan officers and keep track of all your customers very personally. But if your approach is to grow, and to grow a lot, then machine learning is really the way to go, for sure. And I think there is an opportunity for a shared platform in some of these markets, like maybe in Nigeria, where multiple MFIs who serve a very similar demographic with similar loan products could share a platform without compromising your customer information too.
Okay. Sammy, are we good?
Yes. Thank you very much.
All right. Then, Steve, I have a question from Paul. Okay. Paul says, are there softwares for this, or can we learn how to model this as an IT personnel? He is an IT personnel, so he wants to know if there are softwares to this, or is there anything to learn to model such?
So there are machine learning platforms that you buy them and then operate them. It generally requires some data science expertise. So this is kind of interesting. This is a good segue into the development process. So this is pretty much a standard machine learning development process, and this is the process we follow. Wow. We have automated a lot of it using an automation platform that we built so that we can create 10 or 20 models to find the one that's best. 80% of the time of a data scientist or a data analyst is right here. Cleaning the data, understanding the data, making sure the data is in the right context, and then building the process flow to make sure that when you get new data, that the new data is validated, that it's in the right format, that it's in the right columns, and everything is labeled properly. This this whole data cleaning thing is it's tech intensive as well as business operations intensive. You have to know what the data means, and people at the bank know what the data means. We can understand how to take what the data means and then take a data set with 1 million rows and make it nice and clean and usable. But this is something that's not very easily automated. The second part is the labeling. And so labeling is where you're looking at your data and you're deciding what is an outcome. What is it that I want to predict? So I have historical data that has these columns or of things that I want to predict, and you need to be able to label that data. So that labeling, again, as a manual process, requires some data science expertise and then business expertise again. Then this whole thing, you can, once this has happened, you can just run these things and automate that on a machine learning platform. There are a number of self-service machine learning platforms out there. But then you get to this part where so you train 10 models, which model is the best? Then you need to understand what your business goals are, and then what's the business impact going to be of these models that have come out, and how do I pick the best one? So yes, there are platforms that you can use. There is plenty of data science education on YouTube and on Udemy. They're in Nigeria, and I can't remember the name of it. There's actually a data science, there's a data science group for Nigeria that's on LinkedIn, and there's like a data science training company, and I think they're in Lagos, but I don't know for sure. So there's plenty of resources. If you want to learn data science and learn machine learning, you can do it.
Okay. Thank you very much, Steve, for that. I want to address Sammy Prince. I think Sammy Prince is a little bit more interested in taking on machine learning for his business. Part of the reason why we're here is to network still. So I think before this program, I would like you to connect with Sammy Prince, or I'll rather connect you with Sammy Prince so that he'll get more information that will aid or help his organization. I hope that's okay with you, Steve.
Oh, yes, absolutely.
All right.
So I can share this deck. So I'll send a copy that you can share with everybody.
All right.
And it has my contact information here.
Okay.
So I'm happy to answer any questions via email or a phone call or a Zoom meeting.
Okay. All right. All right. Thank you very much for that. Do we still have more?
No, I think really, yeah, I'm done at this point. So we did quickly go through this, but I'm at my hour, which was my time slot. So I'm happy to answer any more questions if anybody has any questions. If not, I'll see everybody tomorrow.
Do we have more questions? Okay. There was an error from beginning. Steve wasn't introduced properly, and I would like him to do that. He's somebody that I've been in touch with for a very long time. He's a wonderful person. He has his listening ears. We've had so many discussions, and we have a project, unfinished project, which we are still going to go back to. So I would like him to talk more about Lokiata, the company which he represents, and what they do, and the benefits that we can gain from his company. Please, Steve.
Okay, great. So Lokiata is about a 2.5-year-old startup. It was started, there are 3 founders. It was started, our CEO is one of the founders, and he was working for the Aga Khan Development Network to help in the digital transformation of the banks that they own. And so they have First Microfinance that's in Burkina, Mali, and Cote d'Ivoire. They have one in Madagascar, they have one in Egypt, and then they have some in the Middle East or South Asia. Our first customer, as I mentioned, was in Madagascar, and that's a microfinance bank. They grew from 20,000 customers and about 15,000 loans per year to 220,000 customers and about 700,000 loans per year in the last 2 years. The NPLs are quite good, less than 5%. And these are on mobile digital loans through a USSD application. So, that was designed not only to help customers at the bottom of the pyramid, but also to acquire as a customer acquisition tool to evaluate customers and find out which ones would be the best for micro loans and SME loans and agriculture loans.